Welcome to the BIP Ventures Extraordinary Pursuits podcast, a fascinating and inspiring journey into the world of venture capital and startups. Each episode offers masterclasses and entrepreneurial stories from some of the top minds in the innovation economy. Get ready to unlock new ideas and gain valuable advice for how to thrive as an innovator and an investor. On this episode of Extraordinary Pursuits, our Mike Vandiver talks with Stephen Bradshaw, a partner in Bennett Thrasher's state and local tax practice. For more than 40 years, Bennett Thrasher has provided tax, audit, advisory, and outsourcing services, earning its spot as a leading public accounting and advisory firm. Stephen is a sought-after expert on compliance as well as state income and franchise tax. He joins us today to explain what technology companies should know about navigating complex tax landscapes to ensure compliance and strategic advantage, particularly in M&A scenarios. Let's get started.
So, Stephen, the concept of taxability, let's talk about that for a minute. If I'm a early stage company or any company, how do I determine if my products and services are taxable? What does that process look like?
Yeah, so this is a kind of a relatively complex part of sales taxes in the software space. Normally, if a company is just selling, some sort of tangible good, it's pretty easy to, it's taxable in most states. And same thing is true for if you're just providing services, it's exempt in most states. So software can sort of fall somewhere in the middle. And so I would say the sort of best way that a software company can really help, determine what if their products are taxable or not. The approach that I recommend is going through what I call a tax categorization study. And, sort of back in the day, we would do a taxability study where we would look at, do research on a sort of state by state basis to figure out which states tax your products. Really, the space has kind of evolved to where we want to provide sort of a higher bang for the buck, to where we really will help you determine, okay, what is the best sort of bucket or categorization for your products? And then we can rely on our research platforms to tell us, we already know what the taxability is of SaaS in every state, right? So we just have to figure out, is your product SaaS or is it data processing or information services or something else? So I would say, if you are selling a very simple SaaS product, meaning it's hosted on a website or customers interact with your software via a internet browser or website, and they're not downloading any software, and they are manipulating, maybe feeding a little bit of data into the software. I think of something like Salesforce as sort of a classic SaaS example. That can be fairly straightforward. But a lot of my clients, there is additional functionality or additional things that are being done. So maybe, if you're selling, or if your product or primary products involve downloaded components and SaaS components, for example, like I work with some cybersecurity companies, and they will have these downloaded pieces of software that sit on endpoints, on devices. Those feed back to a sort of brain, if you will, of software that's in the cloud. And that can be more complex. If you're ingesting a lot of the customer's data and doing stuff with the data and then sort of spitting out answers, that can be considered like data processing. For example, what's data processing, instead of being taxable in 21 states, it's taxable in 4 or 5 states. And that could be really important when you're looking at, your prior 3 years worth of sales, for example, and trying to figure out how much exposure that you have. Because oftentimes what will happen is, let's say a company hasn't done anything with sales taxes and they go to sell a company, the buyer is going to hire a tax diligence team, and that tax diligence team, their job is to find any and all potential sales tax issues and other tax issues. And so they're going to come in with guns blazing. And, if anything looks or smells like SaaS, they will 100%, guarantee, and the states are this way too, but they will say, oh, oh, that's has some sort of internet component. Oh, it's SaaS. It's taxable in, whatever, 20 states. But oftentimes there's a lot more sort of nuanced facts that can come into play that actually, no, SaaS is maybe not the best categorization, or maybe the SaaS is facilitating some sort of tech-enabled service, which again is taxable in much less states. So anyways, all that to say, it's a sort of complex endeavor. I'd say if you're selling a very simple SaaS product, then, that can be something you sort of can roll with an assumption that, yeah, I'm probably selling SaaS. If it's anything more than just a very simple SaaS product, I would recommend working with an advisor just to help you figure out what's the right bucket, what's the right categorization of my products.
All right, great. So there is, really to do it right, there is some validation required to really understand what the customer is receiving and how that's being processed, and some opportunity, so to speak, to maybe categorize in a different manner to manage your sales tax exposure.
Yeah, exactly. Yeah, that's right. And what's interesting too is it also matters how you're invoicing your customer. So if you have a SaaS product and you also have some sort of services or maybe a downloaded component, if you bundle those all together and just charge, for example, like one price for, like you call it a subscription, the everything becomes like, if any product or if any component of that product is taxable in the state, the sort of general rule for these bundle transactions is that your product will be taxable in all the states that tax any of the components. Hopefully I'm saying that clear enough, but it basically expands. If you separately stated them, they will be taxable in sort of less states on their own. But if you put them all together, you also have to tax the whole thing in all the states where they're taxable.
Yeah, so the states are going to lean toward what's most favorable to them from a tax collection standpoint, and they're not going to break out the components. And I guess everyone would have to think about pricing and invoicing in terms of the customer impact and how you want to present yourself to the customer, also with the understanding that there may be some sales tax exposure because of that, but you've got to balance those two things.
Yeah, exactly. Yeah, and the tax dog tail, I guess, should never sort of wag the dog or whatever. But yeah, it is a consideration for sure to make sure you're aware of. Yeah.
But if you are breaking things out already, probably take advantage of that to some degree in terms of your taxability and your tax
Yes,
situation.
it does help. Yeah, it does help. I was recently working with a client that they have a bundled product that it's a bundle of SaaS with a service that is not taxable in most states, but the service they're selling is actually generates a lot more revenue than the SaaS component. The SaaS component is, say less than 10% of the overall product. But because it was bundled, their exposure, if you just sort of applied the general rule and just taxed the whole thing, their exposure was in, multi-million, millions of dollars worth of exposure. And so part of what we advise them and help them through is how can you sort of unbundle those and take more sort of precise taxability positions, I guess.
Yeah. Okay. That would make sense in that case. I totally understand.
Yeah.
So, say I'm not on top of these issues right now, and I'm well on the path, and I'm kind of scaling the company, and really haven't spent a lot of time thinking about this. And what's the process to understand my exposure and to get compliant, and what does that look like?
Yeah. So the process that I sort of recommend, I think, again, it's really kind of the biggest bang for the buck is first conducting a Nexus study. And that's basically will tell you when you establish Nexus, like the specific date that you established Nexus in each state where you did establish Nexus, whether it's a physical presence or economic Nexus as to why you established Nexus. So it's a Nexus study and also an exposure calculation. And so we determine the date you cross the threshold. Then we determine, okay, what is the taxability of your products in those states, and are your customers exempt or not? And so we haven't really talked about that, but if you're selling to resellers or if you're selling to governmental entities or educational institutions or agencies of state governments, for example, those are all going to be exempt in most states. And so we layer in, so we figure out the nexus, we layer in taxability of your products and the exempt status of your customers. And then we will estimate, okay, what's the exposure for prior periods in each state. So, if you had sales into Pennsylvania of SaaS and you are, we know Pennsylvania taxes SaaS, and let's say you're not selling to any exempt customers, then we take your sales of SaaS during the Nexus period and multiply it by the average sales tax rate in Pennsylvania, and then we'll apply, estimated interest and penalties, and that gives us, okay, here's the total exposure. And really that, once you have that total exposure by state, that can serve as a roadmap for, okay, if it's a material amount of sales, generally we will recommend what's called a voluntary disclosure agreement, which is basically a contract between the business and the state, where it provides the business with the benefit of abating all penalties for prior periods, and also having a limited look back period for cleaning up those prior period sales. So typically, you'll get you'll only have to go back 3 years worth of exposure to sort of clean up any prior period exposure. And if it's not a material amount of prior period exposure, we'll just recommend what we call backfiling, which is you literally will just go and register you in the state as of your Nexus date, and then we'll just file returns back to that Nexus date.
All right. And do you ever have clients that say, I just want to file prospectively? What is your perspective or advice around that thought process?
Yeah, it's a pretty common sort of question. If I was a business owner, I would certainly want to just file prospectively. There's kind of 3 reasons why I typically recommend not filing prospectively. The first is that when you go to fill out the sales tax registration, you have to put on there, okay, when did I begin doing business in the state? And the sales tax registration application has to be signed by an officer of the company under penalties of perjury. So basically, whoever the officer is, the company generally feels uncomfortable sort of putting, I began doing business tomorrow, and then signing it under penalties of perjury. So that's sort of strike number one, I guess. Strike number two is that for any prior period exposure, that exposure goes on sort of infinitely or indefinitely. There's that exposure will never sort of close out because there's no statute of limitations because no returns were filed for those prior periods. So kind of going back to our earlier point about officers can be held personally liable. That's sort of another reason, why our clients don't like to, file prospectively. And then occasionally we'll get a client, they'll say, hey, I'll just start up a new legal entity and just go from there. And again, sales taxes follow the business. So if you purchase the assets of another business, the sales tax has what we call successor liability. So it just, even though income tax and other issues might not carry over to the new business, the sales taxes will follow the business assets.
Yeah. Okay. Yeah. And so if there's a material, kind of in two buckets now, if there's a material liability for prior periods, you want to do a VDA because you want to eliminate interest and penalties and minimize the amount you got to pay. If there's not material, you just backfile and kind of let the chips fall where they may, so to speak, right?
Yeah,
you pay it out. Yeah,
exactly. Yeah, I think Texas does abate interest as well as penalties. Most other states is just the penalty abatement, but it is still a benefit, though.
Yeah. And I said VDA, voluntary disclosure is
yes.
VDA is kind of the common term.
That's right. That's exactly right. Yeah.
And walk me through the process for a VDA. How long does it take?
Yeah.
Kind of what's the range of cost to do a VDA if I'm hiring an expert like yourself?
Yeah. Yeah. I mean, I'm not going to sort of sugarcoat it. It's a pain in the butt process to get through. Oftentimes, depending on the size of the company, if it's a smaller company, maybe, if it's in the, say, $5 million revenue range, there might be, 2 or 3 states where a VDA sort of makes sense. Once you get past 20 million of revenue, that's where it gets into, you can have a bunch of states where you have to file VDAs. And the process is very administratively burdensome. There's lots of back and forth with the state in terms of paperwork. First you apply. So we file an application for a VDA. Then the state responds with, okay, here's all the forms you have to fill out. So we fill out all the forms. And there's also sales tax returns for all the prior periods that you also have to prepare and file with the state. And there's sort of a lot of coordination with the state. And so that's for one particular state. But when you layer on, multiple VDAs, it can be a lot to manage. Of course, that's our job, right? Is to manage that. But even for our clients, it can be a lot to, sign this and pay this and log on here. And it's still a lot in terms of just setting expectations. It's a lot. And the amount of time typically will go from anywhere from 2 months to, let's say, 9 months is probably the average amount of time a VDA takes to complete. But there are plenty of instances where it goes, it can go 18 months. And like Virginia, their only VDA agent went on maternity leave and then had some medical issues. And so it was like we just didn't hear back for 6 months, And and then in terms of cost, the VDA fees for a third-party advisor can vary quite a bit. I've seen as high as, $10,000 per VDA. So that's going to be from some of the bigger shops and, all the way down to the sort of, 5,000 kind of range. Really just depends, but it can definitely be costly. And that's where that analysis that I talked about earlier is really key, because you want to limit the amount of states you have to do a VDA in to only those that you're getting it actually is cost advantageous.
All right. Thanks. Yeah. One thing I wanted to circle back on outside of the VDA process, where you're engaging with the state authority, are there opportunities to engage with the state on an anonymous basis to get questions answered so that I kind of know what my position is going to be?
Yeah, absolutely. Yeah. We often work with, if it's a taxability issue, we'll work with tax policy attorneys that sit in the Department of Revenue offices. These are the people that are interpreting statutes and drafting regulations, and we can have informal, company anonymous discussions with them. And same for if it's more administrative stuff, like, hey, we think we might have gotten a notice from the state in the past, but we're not sure. Here's our facts. We can work directly with the VDA agents to also, on a company anonymous basis, ask questions and work through issues. Yeah.
Right. So from a compliance standpoint, thank you for walking us through kind of what it looks like to go back and kind of fix if you have an issue. What are the opportunities to minimize or mitigate your sales tax exposure as you're going through that process, or just in general?
Yeah. So there are some really good ways to minimize exposure, some of them unique to software companies. So 5 states offer business to business exemption, where if you're selling software into these 5 states and you're selling the software to businesses as opposed to individual consumers, these states, even though they normally tax software, they will count these as exempt. And so the 5 states are Illinois, Iowa, Maryland, North Carolina, and New Jersey. And in some of those states, you have to actually proactively get an exemption certificate from the customer. So like North Carolina, for example. Whereas some states like Maryland, you don't have to get anything from the customer. It just applies based on your books and records. So the business to business exemption is helpful specifically for those 5 states. One question I get sometimes is, for companies that are selling to exempt entities, which again would be, like educational institutions, governmental agencies, resellers, those kinds of, nonprofit organizations. My clients sometimes, if they haven't dealt with sales taxes, sometimes they won't know how to sort of ask for this exemption certificate from the customers. And I just advise them just a very simple, hey, we're reviewing our sales tax records and notice we don't have an exemption certificate from you. Can you please, send us your exemption certificate? Or if you don't have one, you can ignore this message. Just a simple email. And that really, that's all you really need to do to figure out, to get your exemption certificates. And so those, again, it's like a one-page document. And there's a number of rules around which states accept which exemption certificates. So that's something a third-party advisor can kind of help you sort through which ones can we accept and is it valid and all that kind of stuff. But anyways, getting those exemption certificates is also a key way to mitigate prior period exposure. And if you know you're selling to exempt customers, I advise for your onboarding process to right when you're onboarding a new customer to request their exemption certificate at that time. Just build it into your process. And then another way is if you are selling to larger, more sophisticated customers, if they may have already paid the tax. Technically, they're required to pay what we call a use tax, which is essentially the sales tax. And if you can get certification that they have paid that tax, then you are not liable as long as you get that documentation from them. And so we help our clients sort of, request that documentation from their customers. And some states will allow you, this is the fourth one I'm talking about now, some states will allow you to apportion or allocate the tax if like my client's customer, the software business's customer, will say they're engaging with an office in New York, their customer's office is in New York, but the users of their software are located all around the country. Some states will allow you to allocate the sales tax based on the number of users in that state. So like New York taxes SaaS and is one of the states that allows you to allocate the sales tax based on the number of users rather than just 100% tax in New York. So that's typically like a multiple points of use exemption is sort of how we refer to that. And then the last one, the fifth one, that's sort of less common is, you can enforce the provision in your contract or your terms and conditions with your customer that says, you, the customer, are responsible for sales taxes. Most of my clients have that language in their contracts, but most of my clients also don't enforce it because that's a tough conversation. Can you pay us $13,000 for the 3 years we didn't charge you sales tax or whatever?
Yeah, I can tell you from personal experience that's an option that doesn't work very often. So.
Yeah.
But it's good to know.
Yeah. It's I've had maybe one client that successfully did it, and he is a CFO, and he had a unique small number of customers, large customers, and so they were able to kind of work it out, I think, based on that unique sort of fact pattern. But pretty much everyone else, it doesn't work.
Yeah. But the flip side of that is I think people should understand that customers expect to be charged for sales tax. It's not a surprise. It's not something that they're going to negotiate unless they feel like they're exempt, and they'll get an exemption certificate. So you shouldn't be concerned in any way about complying and charging the sales tax because it's going to be an issue for you if you don't.
Yeah. I can't tell you the number of times I've had my clients be pretty worried about starting to charge sales tax, only to sort of once they actually start charging sales tax, none of their customers say a thing. It's very common.
Yeah.
Understandable though why they would be concerned about that. Yeah,
that's right. Starting something from nothing when they haven't been doing it for a long time.
Yeah, exactly. Yeah.
So Stephen, most scaling companies early to mid stage really probably can't afford to staff a sales tax group or department. Mm-hmm. So what do you kind of see as best practice with regards to engaging with a external party, and also what sort of tech should I have inside the company? or how do the external advisor, people, tech, process, what does that look like?
Yeah,
Someone who's doing it well.
I would say, I would definitely recommend automated sales tax software for managing the sales tax compliance process, on an ongoing basis. Everyone's sort of heard of Avalara. They're the biggest sort of player in the sort of small to mid-market space in terms of sales tax software. And typically my clients will have a controller or someone on staff that handles some of the sales tax compliance stuff internally. So they'll handle collecting exemption certificates. They will handle, maybe monthly reconciliations between whatever their invoicing software is saying a sales tax charged. They'll compare that to whatever Avalara or whatever, software is saying was charged and collected, and they'll do reconciliation. The prior period cleanup issue is, very occasionally I'll have clients that want to keep third-party advisor fees down, and so they will try to take some of that in-house. And my sort of recommendation there is to try to find an advisor that can sort of scale down with you, but also give you some oversight or just advise you on the process, because it can be pretty hairy. And there's sometimes just questions that is helpful to have someone there that can answer those questions. So for back filings, for example, we sometimes will work with our clients they can file the returns themselves, but we'll kind of prepare the work papers for them. Same with the VDAs. And so really, I think finding a sort of an advisor that can help scale up or down based on your needs. A lot of my clients, it's a capacity issue. They just don't have the capacity to handle the sales tax stuff. And but I definitely do recommend implementing some sort of automated sales tax software. There's a lot of software out there. Again, Avalara is probably the best known. I would stay away from TaxJar. Occasionally, we'll have software clients that have TaxJar, and it just does not work well for software. It works good if you're selling clothing or widgets or something, but not software. But there's Anrock. They're a SaaS specific automated sales tax software company. There's Sovos and Vertex, and there's other products out there. But yeah, definitely Avalara is the most well known.
So Stephen, thanks for your time today. Really informative, and really appreciate your insight. And before we wrap up, any questions for me?
Yeah, I appreciate the opportunity for being on here, and I love podcasts myself. So happy to contribute to the podcast community. One question that comes to mind is are there circumstances where as you're mentoring and sort of advising founders or startups, are there circumstances where you actually tell them, hey, just hold off on sales taxes, or maybe put a temporary kind of pause on it? Any of those kind of circumstances?
Yeah, that's a good question. I think if you're truly seed or really early stage, you're sub 100,000 in revenue or really early, and you're just trying to get your ICP right, you're trying to figure out if there's a product market fit, and your exposure is naturally going to be very, very small, right? You may not have the resources to spend, but as you start moving forward to raise more sophisticated seed money, or even think about a professional investor, no matter what revenue size you are, you need to make sure you have an understanding of this, because as we both talked about earlier in the podcast, you're going to get questioned on it. It's going to be a diligence item, and you'd better off. You'd look better knowing something about this topic and hopefully complying in some way. And if you're not complying, at least you have an understanding of your exposure, so you can address it up front. So I think under that condition, I would say you can kind of put it on pause. But if you really want to professionalize the company, take money, you need to have your hands around this issue. And getting a good external advisor that, as you said, can scale up and down, can provide some, create a budget that's in line with the money that an early stage company has to spend, that'd be important.
Yeah, makes sense. Great. Appreciate it.
Thanks for listening to the BIP Ventures Extraordinary Pursuits podcast. Check the show notes on our blog for the resources we discussed. You can find Extraordinary Pursuits on your favorite audio platform. Be sure to subscribe to the BIP Ventures YouTube channel and connect with us on LinkedIn, X, and Instagram so you get all the stories, learnings, and ideas for ways to thrive in the innovation economy. And if you liked this episode, be generous. Share it.